My name is Justin Muscolino, and I want to welcome everybody to today's webinar on financial accounting. Today, we're going to discuss the importance, how it's being conducted, what best practices, and a lot of different information about the ins and outs of income statement, balance sheets, and all of that. So with that being said, let's look at our agenda for today. So during this video, what we're going to do is go through explaining financial accounting, give a little bit of a background, some information to kind of set the tone for today's session, because during this session, we're going to try to build off each block that we explain. Analyzing a balance sheet. Now, this is really important from an accountant perspective because this is based on facts. And all the information that entered into the balance sheet, as its name indicates, has to balance. So we'll go through that as well. Computing income statement. Now, it might sound very difficult to compute an income statement, but we'll walk through and show you a little bit about the steps that you have to take, and also like how it's involved with your day-to-day responsibilities and what people look for and information like that. We'll also break down the cash flow statement. Now, if you're in an accounting capacity, really in any capacity, you have to be able to look at these documents and figure what's right, what's wrong, what needs updated, what needs amending, all of that good information. So we'll go through that as well. And lastly, what we'll touch on is computing financial ratios. Now, there are a lot of ratios out there that factor into financial accounting. We're going to focus on the core ones. So with today's session, our goal is really to get through the background of financial accounting and then take the next steps and get granular as possible with the balance sheet, income statement, cash flow statement, and other ratios or financial ratios that come into the equation. So we're going to start off today with just what is financial accounting. So let's break it down. So it's really the process of recording, compiling, and reporting, the numerous types of transactions occurring from, daily business operations throughout the time. And this is all known as financial accounting. So it is, a particular branch of accounting, the preparation of financial statements, and we mentioned this earlier, of the balance sheet, the income statement, and cash flow statement, all comprises and falls under the umbrella of financial accounting. So these document the operating performance, of the company over a given time. Now, these are things that are requested from, management, board of directors to see about the financial health of the organization. So, it is done over a given period of time. It depends on the request. It could be done weekly, monthly, quarterly, or annually, sometimes all the above. Now, a number of accepted accounting principles are used in financial accounting. The regulatory and reporting side require that the organization must comply with influence the choice of accounting principles to be applied during financial accounting. So think of it this way: you need to follow a particular method, document that method in case you're ever audited or a regulatory agency ever comes in and looks at your books and records. But the whole goal here with financial accounting is really to look at the health of the organization, regardless of what industry that you're in. Let's go through some basic accounting terminologies. And I'm sure you've heard about these in the past. So we're going to talk about assets, liabilities, revenue, equity, expenses. So, think of it from a personal standpoint. This is applicable too. We all have assets. We have investment accounts, bank accounts, things like that. We have liabilities, credit cards, and other debt that we have. Now, if you're a business, there's revenue that's derived from your daily or your operations in general. And then you have the equity. What is your equity within the business or equity as a total? And then with any business, regardless, small, large, it really doesn't matter. We all incur expenses, the cost of running the business, also known as the overhead. It could be rent paid in an office building. It could be salary. It could be cost to pay vendors. There's a lot of different items that fall within the expense aspect. So we'll touch on. So assets. The best way to look at assets is it's anything of worth or a resource of value that could be exchanged for money. That is considered an asset. So assets belong to people, businesses, and also governments. So an asset may bring in, money for a business, or the business may get anything from using or possessing the item. So when we look at different examples, and we're also looking at, an asset is a resource that has some future economic value to the company. So you keep that in perspective. It's not just what we are currently, but it's also down the road. It could be 6 months, year, 2, 3, 4, 5 years, whatever that is. So example of a few of the assets that are covered under this umbrella, you're looking at cash. And cash is simply, a percentage of all the money that you have that's liquid, that you can touch. It could be in a bank account. It could be in a short-term investment like a treasury, things like that. Assets are also real estate. And from a person's perspective, it's a house that you own or any property. For a business, it could be the building that you operate within. It could be, a piece of land that, that your company owns. It could be anything under that real estate space. Investments. If you're a large corporation, you might have investments in smaller companies, or, any surplus funds that you have, you could put that away for future needs. So the investments, depending on, the risk profile of the organization, whether it's traditional or maybe a little bit non-traditional, it really depends on um, what type of investments your company would put your money in. But remember, if you look at investments, it's not really the short term, it's a little bit longer term. Cash is more short term. And if we go back to real estate, real estate is not a liquid investment, so you can't get rid of it right away. So we're looking long term. Other examples, machinery. If you have a manufacturing company, you need machinery to operate. That's an asset. That's something you own. Yes, machinery does depreciate over time, but it's something you own and operate. And lastly, office equipment. Office equipment could be anything. Could be phone, not anything, but phone, a desk, printer. That all falls in the asset. It's owned by the organization. So that's assets. Let's look at liability. So in general, a liability is something that is due to someone else. A legal or regulatory risk or responsibility is, another definition of liability. So companies record the obligations versus assets in their accounting records. So current liabilities, are businesses' short-term debt that are due in a year or during a typical operational cycle. Think of accounts payable. Now, obligations that are reported on the balance sheet as long-term, non-current liabilities have a maturity of a year or more. So if you look at the liabilities, and we're looking just at debt at this point, you have short-term obligations and then you have longer-term. Now, that could be borrowing money. It could be, other aspects where your company needs those funds to operate. So again, a liability is anything that a company or an individual owes to someone else, usually a sum of money. So if you, on a personal perspective, take out a loan from your bank, that's a liability. So there's a couple of examples here just to go through. Bank debt, which we talked about. From an organizational perspective, almost all companies have some type of debt, not all, but most. But it really depends on your ratio from assets to debt. So if your liabilities or your debt is higher than your assets, that's problematic. So you always want to look at the ratio or the relationship between the two. Also, with liability, you have wages owed. If you're a business, you're going to pay people. You're going to pay people salary. So that is listed as a liability. Mortgage. If your business or even you have a mortgage, again, it's something that you owe. So you need to pay it back. That could be more long term, over a year, most of the time. Taxes owed. Um, Listen, if we file our individual taxes at the end of the year, we might owe money, and that goes to the IRS. For a business, same thing. If we owe any money, and just owing money in general, as the definition of liability indicates, that's a debt. And also money owed to suppliers. If you're hiring outside vendors to do any aspect of your work, that's a liability. So let's go on to equity. So equity, so it's really capital owned or invested by, the company's owner is really referred to equity. It's the difference between the assets and liabilities on a company's balance sheet, and that's used to calculate equity. The current share price, for instance, or a value set by valuation experts or investors, that really determines the equity. So owner's equity, stockholder equity, or shareholders equity are other names that we can associate with the broad umbrella of equity. And as indicated here, equity is the amount of capital owned or invested by the promoter of the company, the owner, or somebody in charge. Equity is valued as the difference between liabilities and assets recorded on the company's balance sheet. Very simple formula. Equity equals assets minus liabilities. And when you put the balance sheet together, it's very easy to segregate those three instances. Revenue, very, very straightforward. So revenue, which is determined by multiplying the average sales price by the quantity of units sold, it's the money made from regular business operations. The top line or the gross income figure is what's used to calculate net income by deducting the costs. So if we look at it, revenue straightforward is the intrinsic value of all sales of goods, commodities, services recognized by a company in a period of time. And again, that period of time could be 1 month, quarterly, semi-annually, annually. It depends. It could be all of the above. Now, revenue forms the beginning of a company's income statement. So all that is derived, which we'll go in shortly. Expenses. I spoke about this briefly, but it's any overhead that you pay to operate your operations, pretty much. Expenses, very straightforward to calculate. And all these formulas that we're going over, you might want to keep in your back pocket just for reference, because they're really handy to have. So revenue minus expense equals net income. So an expense is the depreciation on the value of an asset as it gives rise to revenue. Straightforward. And from a personal perspective, think of all the expenses that you pay to live. Your food, things like that. Those are expenses to operate. And that's a key reference, or the key term you should keep into reference. Now, let's go through the difference between accrual versus cash accounting, because you need to understand the difference. And with which method you go through for your organization, it's going to be very important to decipher the two. So cash accounting is just an easy way to keep track of the revenue and costs for your company. Very straightforward. The only time cash flow is tracked is when it enters or exits the business. I mentioned accounts payable before. Accounts payable or receivable, are not included in this record, just for reference. But cash accounting can be the best option if you operate a very small firm. So let's just put this in perspective again. Cash accounting is an accounting system that makes entries of revenues and expenses when cash is transaction. Very straightforward. So if you look at the depiction below, company goes in two different directions: the cash sale of products and the cash purchase of raw materials. So the cash sale of products equates into entry made in cash revenue. So all the different steps in the process with accounting have to be recorded. So this entry would be in cash, in revenue. Now, the cash purchase of raw materials, that's made in cash expenses. So there are disadvantages of cash accounting. There's always pros and cons with a certain approach. So let's go through the disadvantages. One, not accurate to identify the financial position of the company. It doesn't give a clear-cut picture about the financial health. And that's a big disadvantage with cash versus accrual. It's not recognized by GAAP, IFRS. No big companies use this. So probably you know where I'm going to get at. It's more for smaller companies that operate on tight constraints. And it has a lot of loopholes. So, it may involve a lot of unfair practices. So what you're hearing right now, it doesn't sound like the primary method of accounting that you may use, but for any type of method, there is a purpose with it. So accrual accounting. So look at it this way, a corporation can use accrual accounting, another financial accounting technique to record revenue before getting payment for goods or services sold, or expenses that could be recorded as incurred before being reimbursed by the company. Now, in other words, regardless of when monetary transactions have taken place, the company's accounting records records the revenues earned. So, one of the two accounting techniques is accrual, but the other one is cash, which we discussed before. So there is a difference between the two. So there are advantages of accrual accounting. So one, it gives a complete picture of the financial situation of a company. Think of it as a one-page spreadsheet that outlays everything, assets, liability, and it gives a really good glimpse into how the company is operating right now. It works on standard accounting principles, unlike cash accounting, which doesn't so much. So that's a really good step. Next, the Financial Accounting Standards Boards, has established generally accepted accounting principles, which recognize the use of accrual accounting. So GAAP and FASB both use this, and I guess they put their full weight behind it as opposed to cash accounting. And it also shows correct profit and loss account. So you can just think in the back end, why would I use cash accounting? Well, why would I use accrual accounting? They each have pluses and minuses. From a corporation perspective, the larger you are, you might consider going with accrual accounting. Now, balance sheet. So the balance sheet, I've talked about, or I've alluded this to earlier in the presentation. It contains information about the company's equity, assets, and liabilities at the end of a quarter or financial year. Sometimes it's done more frequently, but it lays out each different equity, all the investments, your assets, your liabilities in a vertical spreadsheet. So components, we talked about, assets before, about current. Current is usually less than a year, and anything above, well, I guess non-current is going to be more than a year. Same thing with liabilities, because you really want to break down, for example, let's look at liabilities. You want to look at your short-term obligations versus your long-term, because that's all going to factor into business decisions as far as when revenue comes in, which generates your net income. Where are you going to put that? Current assets. Current assets, so the assets that a company converts to cash in 1 year. And it really evaluates the liquidity of the company. So if you're evaluating a company from the outside, you want to see how much cash they have on deposit, because it really adds to the bottom line of the value of the organization. So let's look at a couple examples of this. One, short-term investments. Again, it's anything under a year. And if you're think of this, if you're an individual that wants to invest in less than a year, you probably want to go with low to no risk. So we're talking about treasury securities issued by the United States government or a government outside, because it has a full backing. Some corporate bonds, debt in general, are very strong as well, depending on their credit rating. You have marketable securities that are pretty much easy to get rid of. You have account receivables, so that's everything that you've taken in and you're waiting for payment. Cash and cash equivalents, and then inventories. So the inventories are usually short-term in nature and indicated as such on the balance sheet. Current liabilities, it's the short-term financial obligation of a company that are due in a year of the operating period. So anything that's due. It could be a short-term loan to fund a business operation. Anytime that money is taken in, there's a business purpose with it. And you're going to see, we'll talk about non-current liabilities in a second, but anything that wants to be done this year as opposed to in the future. So some examples, we have accounts payable, which we discussed. Dividends payable, if you're a large organization, you pay your shareholders a certain rate. It could be quarterly, semi-annually, annually. That's really determined by the board of directors. And it's really an investment in the company. So if I'm investing in a company, it's great to have a dividend payable. It's very attractive, especially for people who are older in their ways. You have notes payable, anything that you need to pay in a short period of time, and then accrual liabilities, any interest that you have to pay out for a type of debt. Tax payable. Now, if you filed your taxes, for instance, earlier this year, that has to be paid within a year unless you get penalized for it. And salaries. Salaries are short-term in nature. Employees are paid on different cycles. It could be anywhere up to a month as far as the frequency goes. But all of these examples that I went over are all very short-term in nature. Non-current assets. So non-current assets, they're long-term investments of a company that are not expected to become cash within an accounting year. So it's something that you kind of set and forget. It's money that you have, but it's longer term in nature. Real estate is a really good example because real estate is not the most liquid investment. If you want to park your money there for 5-10 years, again, that's over a year. So it's a long-term investment. Other things that, think of it this way, things that are not liquid, they are tough to sell, and that it's beneficial to hold on to for a period of time. And, investment wise, let's look at examples. Bonds. Bonds are typically, the maturity could be anywhere up to 30, 40 years. It could be very long term. Talked about real estate. We talked prior about property. Again, property for a business, it's a tangible asset you can actually see and touch. Plant and equipment, all of that. So that's more reference to like a manufacturing organization. But those are tangible assets. Now we look at the intangible things that you really can't touch, looking at patents. So if you sell a product that nobody else can sell it, you probably have a patent on it. Or you filed with the US government or your local entity to make sure that nobody else can take that. Same with a trademark and copyright. Those are assets because, that patent, think of it as a drug. You create this new drug, you have a patent on it, nobody can touch it for maybe 15, 20 years. That's an investment. So if anybody wanted to purchase your organization, that's one of the reasons why they would. Same thing with trademarks and copyrights. Now, non-current liabilities, they're referred to as long-term debts or financial obligations that are listed on the balance sheet. So again, you're looking at long-term debts that you're not paying within a year. It could be a few years to 10, 20, 30 years, depending on how it was set up. So let's look at a couple examples. Bonds payable. So if you took out debt, you need to pay your bondholders. So the interest that's paid, right? That's a long-term thing. That's not something that's short-term in nature. Long-term loans. Again, you want to fund your operations for a long period of time. If we look at notes, that's more of a current liability. Deferred tax liabilities. If you're not going to pay in the current year, you're going to pay it in future years. you're deferring the tax that you owe, and that is long term. And any long term lease, if you don't own your property, you have to have a facility somewhere. So if you have a lease, that could be a number of years. I mean, I've seen anywhere from 30, 40, 50 years that companies have leases because, if you look at inflation, the price to lease, it keeps up and it's more beneficial over the long term. So this is an example that I wanted to show of balance sheet. So you can see how it's separated. This is a high level overview. So if you look at the comparison, so if you're somebody who's looking at the books and records of an organization, one, you want to look through every item on the list. And then at the end, you want to do a comparison from 2020 to 2021. Where have we seen increases and decreases? So, think of it like getting metrics, output, and you're looking at, where could we see improvements? What could we do differently? Same thing here. These are kind of metrics of the financial health of your organization. And if you look down the columns or the rows, you could see things like flight equipment. Flight equipment increased year over year. You look at cash and cash equivalents. It went up close to 50%, 60%. That's a big increase. So as an individual examining the records, you want to know why. So what you're looking at right here kind of triggers that question, like why? Why is there an increase, decrease, or why do things remain the same? And you can look at an example of remain the same. Typically, goodwill will, but that is an example of stagnant. But this type of example here shows you the type of questions that you might have in the back of your mind. And look at the liabilities. Obviously you want liabilities to go down, but if you're expanding your business operation, liabilities might go up. So let's take a look. Long-term debt increased, 20%. What's the reason for that? The obligations are not following suit. There could be some questioning involved there. Frequent flyer deferred revenue went down a lot. So when you look at these types of balance sheets, that's what you're looking for. And that's what, look at the board. If the board gets a copy of the balance sheet, they're going to scrutinize it. They want to know every little penny, where it's paid, what's coming in. And that's the evaluation they do to see if anything warrants change. So that's an example of what a balance sheet looks like from the asset side, the liability side, and you can also see the equity on the bottom. So the next important thing is the income statement. So the income statement categories a company's revenues and expenses over a period of time. It's usually quarterly or annually, but when you look at the income statement, you're looking at, what's the revenue that's coming in, and it shows a clear picture. Same thing with expenses. So if we look year over year, have our expenses increased? And if they have increased, what's the purpose of it? Again, I use the example prior of expanding your operations. So expenses could increase. And then earnings before for debt, that's also very important too. So let's look at the components of the income statement. So you have 4 different components that we can look at. Sales revenue, COGS, gross profit, operating expenses. So all these 4 items lead to, gross profit and EBITDA. So again, when you're analyzing the income statement, you need to look at information as far as what's the sales revenue brought in. But then you have to look at, comparatively speaking, what's the profit that was generated. Same thing with gross profit. It's going to lead plus the operating expenses to what is, the final amount. So these components are important when you're analyzing the income statement. Now, we could also look at depreciation. If you own any equipment, cars, or whatever it might be, those assets depreciate over time. So I'm sure you heard, if you buy a car, you drive it out of the parking lot, the value decreases by 20% right off the bat. Think of it that way in a sense. And then you have interest, earnings before tax, it's all derived. So the earnings before tax, that gross amount, and then you deduct the amount of tax payables depending on the amount you owe. And then let's look at the earnings before tax and the tax amount. So this all equates into the grand figure of net income, the total amount of income that you derive, whether quarterly, semi-annually, or annually. So everything leads to this point. So you have to look at your expenses, everything, and that will generate the net income. So here's an example of an income statement, and it shows a 3-year period. So if you look at it, this is obviously in airlines, passenger revenue, hit a peak in 2019. And you look what happened in 2020 and 2021. So when you analyze this, questions are going to be derived. And if you look at other figures here, airport fuel, in 2019, it was really high, but it dropped off a little bit. Is that the cost of, gas and oil, just energy and in certain, just a couple of examples of things that you would look at here. But, at first glance, there could be a couple things that you would pick out and probably question. And that's something that the board of directors do. Again, as I mentioned, they look through everything. Cash flow statement. So the cash flow statement tells about the inflow and outflow of cash from the company. It describes the cash on hand at a particular time. So think about the cash, all the cash that comes into your organization. It's coming in and it's coming out, meaning if you generate cash on one item, you might have to pay it out to a vendor or somebody else. But it shows, the statement shows a picture of the cash that you have, depending on the ending date of when the statement was compiled. So there are a couple of components of the cash flow statement. Cash flow from operational activities, your business. Cash flow from investment activities, whether it's short term or long term. If you're investing in money, hopefully you're making money. This part of the cash flow statement will show how much you made. And then from other financial activities. So the cash flows from operational activities, investment, and financial activities kind of give you your grand figure of what the cash flow statement will look like. So cash flow from operating expenses, this is the cash spent or earned due to operations of the firm. So whether you're selling widgets or houses, whatever it might be, that's what's earned from the operations of the firm's activity. It includes revenue, working capital, expenses. Now, we left you with a formula here to kind of compile this together. So each part of the activities of going through all three, there is a formula. So in this particular case, from operating activities, it's net income plus working capital changes plus non-cash components. So as we went through this presentation, we started off with balance sheet, and then we went to the net income statement. So you could see how those components feed into other statements that you have to, present or compile. Investment activities, I've talked about this a lot. It tells the amount spent. So, long-term investments we're looking at right now. What do you have your money into that's deriving investment income? Land, property, equipment. Did you acquire a new business? Now, we talked about expansion of your operations. A lot of companies want to expand and go into new territories. What's the cash flow from that activity? And then also investment in marketable securities. Do you invest in bonds, stocks, and so forth? All of these add up to a figure. And, when you're thinking about the organization, how they pursue investment activities, this is not something that they pull out of a hat. It's derived by their charter. So it lists exactly what type of activities they could invest into. Financing activities. So this includes raising and deploying money for financial activities. If you issue any equity in the company, if you sell stock or any type of shares, that's equity. Lease payments, if you're getting any type of lease payments, payment of dividends, issuing a repayment of debt. So this is all the cash flow from financing activities. And there are a lot more, but this just provides a little glimpse into it. So this is an example. Again, you put your accounting hat on, you look at the figures year over year, and you want to see where the increases, decreases, what's stagnant. And just look at an example. If you look at the total net income, you can see variations from 2019. But you want to look at the particular details: proceeds from equity issuance, repurchases of common stock, proceeds from issuance of debt, net of discounts and fees. So this tells a picture of the amount of cash that you have on hand. And it's a very important figure for a senior management or board of directors to look at. And also for investors. Investors want to see this, that they want to put their money to work in your organization. They want to look at the health or the overall health. Financial ratios. So this is like, for example, the first one, earnings per share. Now, earnings per share is defined as the distribution of the company's profit divided by the number of outstanding common shares. If you ever to look up a quote of a stock, you'll always see EPS listed. And it's something you can calculate yourselves. Fortunately, they do it for you, but this is how they do it. Net income minus dividends divided by the common shares outstanding. So it accounts for all shares outstanding. And again, if you ever get a chance, look at a quote, a stock quote, and you'll see EPS derived under that quote. The next one, PE, profits to earning ratio. So PE is measured by dividing the stock price by the stock earnings. And again, if you look up a quote, as I mentioned, you'll see the PE ratio. And PE ratio gives a nice overview of whether the company is overvalued or undervalued. So a low PE means the company is undervalued. So if you're putting your investment hats on, that's what people look at. If your company is very undervalued, not just overall, but to their peers in a particular industry, it could be very attractive. Now, on the opposite end, we have a high PE, means the company is overvalued. It's not as attractive, and investment dollars might not be flowing in. Now, you might see a high PE, outside the performance of the organization. It could mean that the stock market is exhausted. It's, a bull market is going to turn into a bear. And typically in that kind of scenario, you do see high PEs. The formula, very straightforward. Price per share divided by earnings per share. Return on equity. We all want to get a return on equity. Now, this is the cash spent or earned due to the operations of the firms. And what ROE tells you is about the efficiency. Now, how does a company generate profits? Are they doing it in an efficient manner? Formula is straightforward. Net income divided by average shareholders' equity. But this is a figure that's calculated immensely to really, figure out, the cash spent or what's earned due to overall day-to-day operations of the organization. Debt to equity. This is a very important one as well. It measures, it determines the financial leverage of the company. So a higher debt to equity ratio tells higher risk to investors, stakeholders. So think of it from a personal perspective. Are you going to invest in a company that has a lot of debt, but a little equity? You might be thinking about startups or firms, firms that are just beginning, that'll take a while to build profit. But if you're looking at an older organization, that's highly suspect. And it's something that you should look at. So the formula is straightforward. Liabilities divided by shareholders' equity. So we went through a lot of good stuff during this presentation. We started out by going through just the basics of financial accounting, the terminology. with financial accounting, depending on your business, well, regardless of your business, you should understand the ins and outs, the foundational sense, and that's what we build upon. We went through the balance sheet. We looked at the different components and an example. So if you're putting that accounting hat on again, that detective hat, there's a lot of information that's derived from the balance sheet and determines like new approaches, new streams, acquisitions. So very important. We learned about the various parameters in the income statement. We looked at the different components and we looked at the example too. Again, like when you look at the best thing to do is look at examples of balance sheets and income statements and you see how it's derived. And it's very telling because if you put that accounting detective hat on, you'll be able to learn a lot more. And then lastly, we went through ratios. There's a lot of ratios that are important. We went through the top few, return of equity, PE, earnings per share. These are big ones. And as I mentioned, if you ever want to get more information, look up a stock quote. You'll see it there. So with that being said, I want to thank everybody for joining today. For more resources, please feel free to reach out. But I just want to thank everybody for the time today.
If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions and I will respond to your comments.